Welcome to csstudents.com, a learning portal for company secretary students. The Companies Act 2013 effected many conceptual changes in the key provisions of the company law in India. The loan to directors is one of them. In the previous part of the presentation, we discussed the basic provisions of Section 185. We also discussed the other related entities of the directors, whereon restrictions are applicable. In this second part, we would discuss the exemptions, penalties, and implications on the business. Let's start with the exemptions. Means, if a case is covered under the exemption, company can give loan to a director, or the other entity, wherein director is interested. Earlier, Section 185 used to provide two exemptions. Means, if a case is covered under the exemption, company can give loan to a director. These exemptions were given in the proviso to subsection 1. Additionally, third and fourth exemptions were given in the rules, which relates to the wholly owned subsidiary and subsidiary. Effective from 26th of May, 2015, the Companies Amendment Act 2015 became applicable. Under this new Amendment Act, the two exemptions provided in the rules also became part of the main Act. Let's see the exemptions given in the proviso of the subsection 1 of Section 185. The first exemption relates to any loan given to the managing director or whole-time directors of the company. In most of the cases, managing director or whole-time directors are employees of the company. And as part of the compensation or staff welfare, many companies provide loans at a concessional rates to their employees. These may be either home loans or car loans or loan for some other purpose. It's part of a larger employee welfare. Therefore, like other employees, managing director or whole-time directors are also entitled to get these loans from the company. Accordingly, an exemption is granted under the proviso. As per the exemption provision, a company is permitted to grant loans to its managing or whole-time director if such loan is being given as a part of the conditions of service extended by the company to all its employees, or such loan is being granted pursuant to any scheme approved by the members by a special resolution. Means, if the company has a policy or other terms and conditions applicable to all its employees, that company can grant a loan to its managing director or whole-time director. If no such general terms and conditions are existing, a company frame a scheme, get the members' approval for that scheme, and grant loan to its managing or whole-time directors under that scheme. Certain important points to be noted relating to this exemption. First, loan could only be given to managing or whole-time directors. Means, no loan could be given to non-executive directors. Second point. Loan could only be given if it's a part of the conditions of service, or if terms of employment doesn't provide for any such condition, then loan could be granted under a scheme which has to be approved by the members first in the form of special resolution. The second exemption given in the proviso relates to the companies providing loans and guarantees in their ordinary course of business, such as a banking company or non-banking finance companies, etc. These companies are free to give loans to their directors, and the exemption is not limited to only managing or whole-time directors. So, as per the exemption, a company which in the ordinary course of its business provides loans or gives guarantees or securities for the due repayment of any loan, and in respect of such loans, an interest is charged at a rate not less than the bank rate declared by the Reserve Bank of India. Means, companies in the business of providing loans or providing guarantees or securities can extend a loan to its directors or to other interested persons. The only condition is that the interest charged for such loan is not less than the bank rate declared by the Reserve Bank of India. The objective of this exemption is to allow only arm's-length transactions by banking or finance companies. It is important to note that This exemption is available only to the companies which are in the business of providing loans, or providing guarantees, or securities. Other companies are not covered under this exemptions. As discussed, there are two more exemptions, earlier provided in the rules, have been added in the Companies Act. Let's understand them with an example. X Private Limited is a company, and Mr. X is one of its director. There is a wholly owned subsidiary of X Private Limited, and Mr. X is also director in that wholly owned subsidiary. With the plain reading of Section 185, X Private Limited cannot give loan to any private company with common director, and therefore cannot give loan to its wholly owned subsidiary also. From the business perspective, X Private Limited is the parent company, and, if required, it has to extend the financial support to its wholly owned subsidiary. The whole objective of Section 185 is to curb the undue benefits taken by the interested parties at the cost of other shareholders. Therefore, if a company is extending loan to its wholly owned subsidiary, there is no outside interested party who is taking benefit. Any loss or profit of a wholly owned subsidiary is of the parent ultimately. Therefore, the Act also provides the following exemptions. First, any loan made by a company to its wholly owned subsidiary is exempted, even if there are common directors. Second, any guarantee given or security provided by a holding company in respect of any loan made to its wholly owned subsidiary is also exempted. But these exemptions are limited only to the wholly owned subsidiaries. If there is a partially owned subsidiary, then these exemptions are not available. However, from the business perspective, a company may have to extend support to its partially owned subsidiaries also, for which some relaxations have been provided. It allows any company to give guarantee or provide security with respect to any loan made by a bank or financial institution to the subsidiary. Means, if the subsidiary is covered under the criteria of restricted persons, wherein director is interested, a company cannot give any loan to it, but at least give guarantee or provide security with respect to a loan taken by that subsidiary, subject to the condition that the loan is given by any bank or financial institution. However, for availing these exemptions, the common condition is that the said loan is utilized by the subsidiary for its principal business activities. Exemption to private companies. Under its notification dated 5th of June, 2015, the MCA has granted certain exemptions to private companies, including from the provisions of Section 185. However, this exemption is limited to certain set of private companies only. So, as per the notification, Section 185 is not applicable on a private company if certain conditions are satisfied. First, there is no other corporate entity has invested any money in the capital of such private company. Means, only individuals are the shareholders. In case, if any private company has any corporate shareholder, there is no exemption and Section 185 shall become applicable. Second, borrowing of such private company from any bank, financial institutions or any body corporate is less than twice of its paid-up capital, or 50 crore rupees, whichever is lower. Means, if a company is having borrowings of more than 50 crore, there is no exemption from Section 185. And if borrowings are 50 crore or less, then one needs to check if borrowings are more than twice the paid-up share capital of that company. In case, if the borrowing is higher than double the amount of share capital, there is no exemption from Section 185. The third, and the last condition is that private company has no default in repayment of such borrowings at the time of making transactions under Section 185. So, if some default relating to borrowing exists, a private company cannot avail the exemption. So, we discussed the basic provisions of Section 185. We also discussed the interested persons. We also discuss the exemptions given in the Act and in the rules. Now, we discuss the penal provisions. Means, even with the prohibition in the law, some company extends the loan, or provide guarantee, or security, in violation of Section 185, then what happens? Definitely there are penal provisions given in the Act itself. Subsection 2 of Section 185 deals with the punishment. As per subsection 2, if any loan is advanced, or a guarantee or security is given, or provided, in contravention of the provisions of subsection 1, the company shall be punishable with fine, which shall not be less than 5 lakh rupees, but which may extend to 25 lakh rupees, and the director, or the other person, to whom any loan is advanced, or guarantee or security is provided, or provided in connection with any loan taken by him, or the other person, shall be punishable with imprisonment, which may extend to 6 months, or with fine, which shall not be less than 5 lakh rupees, but which may extend to 25 lakh rupees, or with both. So, as a company secretary, you need to be very careful with Section 185. If your company contravenes the provisions, then the company and the other party shall be subjected to the penal provisions. In this presentation, we discussed the provisions relating to loans to directors. We also discussed certain examples. Section 185 has been in various forums for discussions. Certain industry bodies have made some representation to the government. Some have advocated to grant exemption to private companies. In one of the drafts, issued by the Ministry of Corporate Affairs, it was proposed to grant some relaxations. But nothing has moved so far. It is anticipated that government may grant some relaxations. Viewers can post their questions and comments on the presentation and also seek clarification on the provisions. If you liked the presentation, please click the like button below the video screen. Thanks for watching. For more presentations, keep watching this channel.